Corporate finance practice problem using OneNote. Coefficient of variation to project alternatives. Get ready. It's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side in the Practice Problems tab, then down in the 1322 Coefficient of Variation to Project Alternatives tab. Also note that when using OneNote, look at the Immersive Reader tool. Many of our presentations up top will be mirrored down in the text area down below, same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have our information up top. We'll go through the calculations then on down below. We are imagining we have two projects that we are considering, and we want to do our analysis on the side-by-side for the projects. We're going to do our ratio type of thought process for that analysis to get the expected value, and then to be looking at the coefficient possibly to think about the amount of risk that could be involved. So we have the project one, cash flows. These are what we are projecting the cash flows to be in the future, and we got our probabilities related to them. So same kind of scenario, we're projecting out into the future. We're trying to think what is going to happen into the future, and then trying to think about the likelihood of that happening. So obviously we don't know. We would have to look at the past and see what has happened in the past, then consider the economic conditions into the future, and think if we can put down in some systematic way what we think the probabilities of particular outcomes would be. This is one way to structure our thought process as we make our decisions into the future. We have that for the project one and then project two, and then we'll do some comparing and contrasting between the two. So let's take a look at project one first. We have the cash flows. We're going to assume the cash flows at the 900, the 1008, the 1009, the 2006, and then we have our probabilities for them. Again, we don't know what these probabilities are. We're estimating into the future. This is one way to structure our estimates as we think about this into the future. And also note that we could have four numbers here. We could have three numbers here. We could have, usually less than 10 on the basically expected cash flows, and then of course applying our probabilities to them. Probabilities having to add up then to 100%. So we've got the 40, 20, 20, 20 in this case. And then we have our expected value. So the 900 times the 20% is the 180. The 1,800 times the 40% is the 720. The 1,900 times the 20% is the 380. And the 2,600 times the 20% is the 520. The 180, the 720, the 380, the 520, those add up to 1,800, then our expected value. So based on this information, this is what we would expect to happen. This is kind of our average value, in other words, or the mean. And then we want to think about what the variation would be from that average point, so that when we compare it to the second project, we can look at two things: the expected value here, as well as basically the variation from that midpoint, from that average, from that mean, from that expected value, which could give us an idea of the level of risk involved. So let's do that same kind of thing so we can get to that variation down here. So we got the cash flows once again, the 900, the 1,800, the 1,900, the 2006, the expected value, which you can imagine being basically kind of like the average. That's the 1,800 all the way down. We're going to compare each of our items to that 1,800. The 900 minus the 1,800, negative 900. The 1,800 minus 1,800 is 0. 1,900 minus 1,800, 100. 2,600 minus 1,800 is 800. Then we will square it. So the 900, negative 900 squared. Let's just do one of these to pick one of them up in the trusty calculator, making sure we have a squared button. 900, negative 900 squared is the 110, or the 810,000. 0 squared is 0. 100 squared is 10,000. 800 squared is the 640. Then we're going to pick up our probabilities, which are the 20, 40, 20, 20. So the 20, 40, 20, 20, let's just pull that up here. There we have those. Then multiplying the 810 times the 20%, we have the 162. The 0 times the 40% is 0. The 100, or the 10,000 times the 20%, 2,000. The 640 times the 20%, 128,000. Adding those up gives us the variance of the 292,000. That number is squared units, however. We typically want the standard deviation then. So we would do that by taking the square root. The 292,000 square rooted gives us about the 540.37. And then we're going to compare that to the expected value, which is kind of like the mean or the average. So we take that number divided by the 1800, and that then giving us the 0.3002 about. So we got the 0.300. You could see this in a percent, could see it in a decimal. That number is what we can use to compare to the second project to consider that risk kind of level. Same thing for project 2 now. Let's take the project 2 numbers. Here's the flow. Here's the probabilities that we came up to be projecting out into the future. Let's calculate the expected value then. Cash flows that we came up with, the 500, the 900, the 1008, the 2004, the 2009. Note that we have 5 numbers here as opposed to up top when we had the 4 categories up top. We do not need an even level of categories because what we're doing is getting to that expected value. So whatever level or however many categories we think would be most appropriate to get to the most accurate expected value that we can think of, that's what we will do. Then we got our probabilities, which we said were 10, 30, 10, 30, and 20. These have to add up, of course, to 100% to make any sense. When we want to make sense needs to be made. Sense needs to be made. So we have the 500 times the 10% is 50. We have the 900 times the 30% is the 270. We have the 1,800 times the 10% is the 180. The 2,400 times the 30% is 720. The 2,900 times the 20% is the 580. Adding up the outer column, we get to that 1,800. That's our expected value. Now, of course, we can compare the expected values of the two projects, the two investments, the one with the higher expected value being typically the better one. However, we also want to take into consideration the level of risk that could be involved. One way to get an idea of that is to do our calculation, similar calculation we had down here for the second option. Cash flows, same cash flows as we had up top. Expected value, the average or the mean, basically, is that 1,800. We take the difference between each expected value. The 500 minus the 1,800 is negative 1,300. 900 minus the 1,800, negative 900. 1,800 minus 1,800 is 0. 2,400 minus 1,800 is 600. 2,900 minus 1,800 is 1,100. Then we will square each item. Let's just do the first one, just to practice the squaring, making sure we have a squared button on the calculator. So we pick up the 1300, make it negative 1300, and square it, 1,690,000. So there we have that. We do that all the way down. 900 squared, 810,000. 0 squared is 0. 600 squared is 360,000. 1,100 squared is 1,210,000. Then we apply our probabilities of 10, 30, 10, 30, 20, 10, 30, whatever that was. There it is. Then we multiply that out, so the 1,690,000 times the 10% is going to give us the 196,000. The 810 times the 30%, 243,000. The 0 times the 10% is 0. And then the 360,000 times the 30% is the 108,000. And then the 1,210,000 times the 20% is the 242,000. Adding up that outer column gives us the variance of the 267,000. That's in squared units, however. So we typically want the standard deviation. Let's take the standardized of the deviations, which is going to be the 762,000 square root, which is the 872. And then we're going to compare that to the expected value, the mean or the average, to then get to the coefficient of variation. So taking that divided by the 1800 gives us the 0.4849 about the 0.485, rounding 3 digits out. So now we can do our comparison. If we look at these two projects, we got the first one with the 1,800 expected value. The second one also has 1,800 expected value. So they're even with regards to the expected value. So that then would lead you to believe that what you want to do is pick the one that has the least amount of risk typically, because that would be more likely to hit on, you want the lower risk generally if the two expected values are the same and this one, the top one, has the lower amount of risk. So the two things we take into consideration then being that expected value, that average value that we expect to have, and then the level of the risk. Obviously, we would like the higher expected value, the better, and the lower the risk, the better. So if you're in a situation where the expected value is the same and then the risk is different, then we would typically want to pick the one with the lower risk. If you have the expected values that are different, then we might want to go to the higher expected value. If obviously the higher expected value had less risk, then we would want the higher expected value with less risk. If the higher expected value had more risk, then we would have to be considering whether or not the added level of risk was justified in order to have that increased return. And we'd also have to be considering that kind of situation with regards to our risk tolerancy level and the other types of investments that we have and what kind of investment we need to fit into our overall type of risk assessment with our overall type of asset situation and finance situation, our whole accounting situation.